Common itemized deductions, which is claiming your Schedule A if it is more than your standard deduction. So, medical expenses is a big one. And that is it has to be at least 7.5% of your AGI to claim it. Then you have your state and local taxes, which includes your property taxes, sales taxes, but it's capped at $10,000 per household. Then you have your home mortgage interest, which actually is subject to your income limit. And then charitable contributions. There are rules that apply for cash and non-cash donations, which we will cover in another video. There's also above the line adjustments that reduce your AGI, which anyone can take if they're eligible. So you have your traditional IRA contributions, your student loan interest, your health savings account or contributions, and then you can take 1/2 of self-employment tax. Now, each of these have different rules and regulations in order to claim them. We will dive deeper into another video on that. And for businesses, business deductions cover your ordinary and necessary expenses like supplies or even your home office deductions. Next, tax credits. These provide a direct reduction of the taxes you owed. Credits are generally more valuable than your deductions because they reduce your tax bill dollar for dollar. Some of the examples of your tax credits would be like the child tax credit for qualifying children, the earned income tax credit for lower to moderate income workers. With this one, just know that you do not have to have a child to qualify, but there are some income restrictions. Education credits, like the American Opportunity Credit or the Lifetime Learning Credit. You also have the Child Dependent Care Credit for care expenses that you need to work. So if you need to work, if your child has to go to daycare, that could count. You probably hear a lot about the Clean Vehicle Credit, which is for qualifying electric vehicles. These rules are complex, so please be sure you are getting with somebody before you are trying to claim this. And so are the Residential Clean Energy Credit for solar panels. Get some water real quick. Let's see. A critical point that I have to point out is the eligibility and documentations. You have to meet the specific criteria for every deduction or credit you claim. Documentation is key. You have to keep records, receipts, statements, mileage logs, charity letters, whatever it is. Year-round planning versus tax season scrambling. This is more of a proactive approach. Tax consequences arise from the decisions made throughout the entire year, not just through tax season. So by planning throughout the year, you can avoid surprises. You could potentially save more, you can reduce stress, and be more informed about your financial decisions. So, some of the key planning areas and strategies. Retirement contribution. That's a big one. If you aim to maximize your contribution to your 401k and your IRAs, understand that the tax differences between traditional and a Roth would help you. Estimated tax payments. If you're self-employed, a freelancer, or even have significant investment income, you're likely to make quarterly estimated payments to avoid penalties, or you need to make it. Tax loss harvesting. Selling losing investments to offset capital gains realized realized from selling winning investments. So if you know you're going to have some losses and you have those losses, it could help you actually balance the capital gains. There are some specific rules that apply to that, and we can dive deeper on that. Bunching deductions. If your itemized deductions are close to the standard deduction amount, consider grouping the deductible expenses like a charitable donation into a single year to exceed that threshold for the year. Timing income and expenses, especially for businesses or even self-employed people. Strategically timing when you receive your income or pay expenses near the end of the year can impact your tax liability. I know you guys probably heard this one too. Health savings account. If you're eligible, HSAs offer a powerful triple tax advantage. So contributions that are deductible, growth is tax-free, and withdrawals for your qualified medical expenses are tax-free. So that's a big one. If you know you're going to use the HSA, it's definitely worth taking advantage of. Now, understanding not only that side of it, but the record keeping side. I can't stress this enough. There are a lot of tax strategies that may be beneficial to you, but won't mean anything if you are missing the tax record side. Be consistent making record keeping a regular habit. You have to use tools to leverage these, such as maybe an accounting software like QuickBooks, expense tracking apps. QuickBooks has one, Hurdler has one, Wave, or even a spreadsheet. Whatever works for you, find a way to track all of this. If you have a business, separate your finances. You maintain a bank account for personal and a bank account for your business. Those finances, deductions, credits, expenses, everything is separated. Always make sure you have your documents backed up. I use the cloud. So make sure you scan important documents using the cloud storage or even a printed copy, whatever works for you. And if you're using a vehicle for business, you have to keep a mileage log. Any of these apps can automate tracking your mileage, which makes it beneficial when you actually log in at the end of the year to get your P&L statement. They also provide you your mileage log to let you know how many miles you drove that year. Now, you have to keep those records for at least 3 years from filing. But in some instances, you may want to keep it up to 7 years because you actually never know when you're going to get audited. Good planning helps you sidestep common errors that people run into. So now we're going to go ahead and identify some of the frequent mistakes to avoid.